Hey everybody, this is Jose. We are about to get started. I'm just doing a minor change on my other computer screen here. Just bear with me. We're starting in just a few seconds, okay? Just one moment. Thank you so much. In the meantime, if you could have a quick hello on the chat box, as we always do, I would know that sound is good and ready to get started. Please do that. Thank you so much. I just need literally no more than 30 seconds. I'm almost ready here. Just had to reboot something, but we'll be fine right now. Here we go. Perfect. Ready to get started, everyone. October 20, 2022. My name is Jose Velasco. This is Options Trading Live. We're going to be looking at the markets. Of course, the product, the instrument to be traded is options. So we're going to be looking at the options markets and basically adapt to what the market has to offer. We may do directional trading. We may do non-directional trading. Options are great in the sense that we can do many things with them. So we'll adapt to what the market has to offer. Before we get started, I would like to highlight our financial disclaimer on the upper left side of the screen. Please read it carefully. This is important information. Please read it completely. So that way all is understood as we are getting into the live markets, since trading carries with it financial risk. The agenda for today, we're going to review the market, understand what's happening out there, and from there we'll move into trade management. We have open positions, we need to manage them, and from there we'll look into finding new market opportunities. That is the plan, and with that said, I am now getting rid of the introduction slide and ready to jump into the real-time charts. Right here is our S&P 500. Okay, so first of all, let's look at the VIX. Okay, let's look at the VIX, VIX, implied volatility index. So where are we at? The VIX is currently trading at levels of 30. This is real-time pricing for the VIX. Obviously, when you look at the price range of the VIX, 30 plus has been a high in the recent times, 20 something has been a low in the recent times. We're trading at 30. So I guess it's fair to say, a bit oversimplified, but I guess it's good enough. It's fair to say that implied volatility values are more or less in the middle. The premiums for options overall across the 500 stocks of the S&P 500 index as an average, they are not too expensive, they are not too cheap either, and therefore, from that sense, I don't have a priority or a preference to go either long or short options, long or short Vegas. No preference. The preference would be dictated in cases like this by whatever is it that you already have in your portfolio. Let's say in your portfolio you have 3 iron condors, so all of this is short Vega, all of that is short premium. So then to offset that Vega exposure, it would certainly be wise to get into long Vega positions, and therefore maybe you would be building either directional or non-directional strategies that are positive Vega, for example, double calendars. That would be the idea, okay? But really, by looking at the VIX today, it doesn't tell us too much, given the fact that we are more or less in the middle. Now, when looking at the S&P, I am looking at the S&P 500 index. I have to say that this market, for a long time in 2022, this market has been a teaser, a real teaser with non-stop contradictory information that forces us to be cautious. We always should be cautious as traders, but there are times where it's okay to take a bit more risk because market conditions suggest to do so. With the S&P, it's not been the case for a long time. So notice what has been happening here. Going back in time just a little bit, so we had this last lengthy down cycle where the market was crashing very hard, and guess what? Sometime in the middle of this cycle, we saw buyers coming in. The blue line above the gray line means implied volatility of the calls is above implied volatility of the puts, and therefore buyers were showing up in the options arena. We did not see that buying action move the stock higher yet, and the S&P kept falling, but we could see how buyers were being accumulated in the options arena with those either calls being bought or those puts being sold, pushing the blue line to be above the gray line. Now, what happens when the climate change now, and now it's time to, we have more evidence and it's time for us to become a buyer at this moment in time. Guess what? The climate was not confirmed with those thin blue dots instead of thick blue dots, like what we had on the left. The dots were thin, raising a flag and telling us, hey, be cautious because there are buyers in the marketplace, but price action is basically not showing it in a way that implies a statistical advantage for us traders. And sure thing, and sure thing is something that as traders we should never say, because nothing is a sure thing ever, but you get my point. I'm just using the English language if I can. So sure thing, I want to say it again. Next thing you know, with this undecided climate, so we had to see the market go down again, going back to a red climate. But of course, because we got buyers on board, now the red climate didn't last too much, and then came back to blue after this fantastic move up, right? Came back to blue, but again, thin dot, right? And then back to red, still buyers on board, blue line above the gray. Okay, and now the market is fighting it again, and back up, back to be blue 3 days in a row, but 3 days in a row is being a thin dot. In other words, the market, it's not stable yet. We do have buyers above sellers, okay, blue above gray. So the moment we see a blue dot that is thick, we are now being told, based on AutoClimate, based on the algo, that we have a statistical advantage in our favor. But so far, patience is needed, and much more non-directional trading than directional trading makes sense, unless you are trading, short-term intraday, things like that. And you can see how the pattern really, it's a sideways market that didn't go too far. The only time where it was moving was before, where we had sellers above the buyers. Okay, during all this period of time, we had sellers, gray line above the blue line, and that justified this powerful move. But at this moment in time, we have a contradiction: red with the blue above the gray, or thin dots, and all of this is generating all this sideways price action. Which implies we need to be careful, because betting too hard in a direction may be, the product of hope, and that's obviously not advisable. Looking at the chat box here, Joe, good to see you, my friend. With volatility so crazy, how would you long Condor fare? Let me talk about that in a moment. And by the way, Joe, I saw an email from you, but I did not have time to read it properly since I was getting into the session. So if you want to phrase your question here on the chat box, you can certainly do that, and happy to answer to you here during the session, okay? Jeff, it's good to see you as well. Very nice, very nice. Cool. So back to you, Joe. With volatility so crazy, how will long condors fare? Well, it depends on how you construct it. It depends on how you construct it, because especially if you're going to use strikes which are very near to the at-the-money strike, probably it's not going to work too well. Okay, and the reason why is because, again, the VIX is still trading at 30. So volatility for more stocks, it's not too expensive, but certainly not too cheap. And if you set up those condors and the volatility is not too cheap, those condors are going to be expensive, meaning that for you to get a profit, you need moves to be quite significant, and the size of the profit is going to be limited. With long condors, the size of the profit is limited, and the cheaper the debit, the more the profit. So if your initial debit is going to be quite high, then the profitability is going to be quite limited. Okay, so I would say probably not the best strategy to be used at this moment in time. Again, the best strategy to be used, is probably more on the non-directional side. The long condors are technically a non-directional strategy, because you can profit if it goes up or if it goes down, but it has to move by a lot. Right, so it's not a directional strategy either, because, how do I put it? If you do a strangle, for example, okay, which that one is a tough one to make money with, but let's say you do a strangle where you buy a call and a put at the same strike. The moment the stock moves a little bit higher or lower, immediately you start gaining some profit, unless it takes a long time for the move to happen, and then time decay is truly killing you. But the moment it moves, immediately you would have delta sensitivity, and you start making some money on that. When you do a long condor, you need way larger of a move in a specific direction for you to start profiting. So while the name of the strategy is non-directional, I would argue it's not a good definition, even though it is a proper definition. But I would argue that, from a practical point of view, it is not a very good definition, because to me, being non-directional is that, you don't care much about what's going to happen. So it moves up or down immediately, you start profiting. Or if you bet on a range, the range is very wide, and no matter where you're in the range, you profit. But when you need a large move to happen, either up or down, while the name of the strategy is non-directional, the type of strategy is technically non-directional. To be honest, it's very directional, because you need that very big move to happen. You don't care if it's up or down, but you do need a big move, which is definitely something that happens in a specific direction. So, we don't have a clear climate. So betting on a clear direction, it's a problem, because if you bet on the market falling, what's the issue? The blue line is above the gray. That suggests it's going to go up. But at the same time, the climate being unconfirmed with a thin dot, it's telling you that it may go up, but not too much. So what do you do? Is that making sense? So being non-directional from a purist point of view seems to be the greatest sense to me. At least, again, as always, I share, with you guys how I trade, my mindset, the strategies I use, and so on, my set of rules. That's what I share with you guys. And there are many ways on how to trade, okay? And other applications could certainly be profitable as well. So as always, we're having an open conversation here, okay? Mark, it's good to see you, my friend. I get you. You will have to go in a little bit. Got you. No problem. Cool. So let's begin, guys. We have just done our market analysis. Again, basically, a long story short, we're gonna shoot for non-directional trading. And I know it's been a long time that we focus on non-directional trading. Well, that's what the market has to offer at this moment in time. So in that sense, it makes sense to be in tune with the market. When it comes to positions, okay, new core is the first position that we need to manage. Last week, as you probably know, especially if you are a fan of the sessions and you are following the sessions in a regular basis, so I was not able to conduct any session last week, and the week before I did, but the week before I did not. Again, it's been a difficult schedule for me this month of October, and of course I always wish to be as available as possible, but I guess it's life and responsibilities and things of that sort. So I could not. So what happens is that when you look at new core, which is a strategy that I know you guys have been massaging, because I know you know the rules. But if you look at my case, okay, notice how I got 100 shares of new core. And the reason why I got that is because in the prior week, I didn't do the massaging, I didn't do the tweaking, I didn't do the rolling, and therefore I've got assigned on 100 shares. So again, just like I did 2 weeks ago, I'm going to work on it, okay? I'm going to do the conversion now, I'm going to do the tweak now. So for the ones of you that are newer to the sessions, you can see how this is done, okay? Now, having said that, this week is a bit different because the expiration date is October 22nd. So that is Friday, right? If I look at my last version of Nucor, you will see, if I right click and edit and risk graph it, you will see that I only got 2 legs, which is not correct. Okay, it's not correct. I actually got more than 2 legs. Okay, why do I have more than 2 legs? Well, because I'm trying to say many things at the same time. I'm very sorry about it, my friend. I have only 2 legs because the prior two legs, to make it 4, expired and I got assigned. So I got shares of stock instead of legs. So the reality is that what I'm going to do here is very simple. So what we need to do is, okay, I'm going to copy the primary spread. Oh, you know what? I'm not going to copy it. No need to copy. I'm just going to edit. And I'm going to add 2 more legs, okay, which is the 2 short units that I need to have in this trade. So I got a call, I got a put, okay? So I need a call and I did the put. The strikes I'm using are 150, okay, and for the call and 125 for the put. So I'm just gonna do this, okay? And when it comes to fill prices, for now I'm gonna make it mid, okay? So if I was to do, pay attention to this, okay? If I was to do 21st of October, 150 call, and that's buy and sell 150 call. So that would be my calendar spread. The problem is that because October 21st is the expiration date, and October 21st, right, is also the expiration date of the one I'm selling, I cannot do that because this basically would close my trade. If I own the 150 call and I sell the 150 call with the same expiration date, I am actually closing the call. So if you recall, when we do double calendars, you are doing double calendars the whole set of weeks until you get to the last week, which is when the expiration takes place. And on the last week, what we do is that you go one strike higher, in this case 152.5, and in the case of the put, you will go 124 because there is no 122.5. Okay, so you go one strike higher for the call, one strike lower for the put, and you are technically converting the double calendar into a double diagonal. Okay, so if I do that, okay, that will bring in X amount of credit for the call, X amount of credit for the put. Okay, this is what this would bring in, but I cannot forget what I had until that moment in time, because all those credits, while they don't show on the screen because those legs were expired when I right click, the reality is that I had collected 500 and 300. So those 582, those 305 are credits of something I did collect in the past. So 305 on the call side. Okay, now the midpoint shows nothing because the bid is 0, even though the ask is theoretically 119. The bid is 0, so probably I won't be able to get anything here. So I'm just going to leave it the way it is, 305 for the call. Okay, and on the put side, I got 582. Okay, so 582 plus 146, which is what I'm likely going to get if I do this. Okay, give me a moment. Here we go. Here's my calculator. So I got 582 already. And now if I get additional 146, that's going to be a total of 728. So if I do 728, okay, so now I want to be able to see the risk profile I got for this particular trade strategy. Okay, so on the upside, of course I can make a lot of money, but that for this to happen, I will need that stock to rally all the way to 151, which is extremely unlikely because it's currently trading at 125. So probably this green zone is not going to happen. And on the bottom zone, in my case, okay, it's looking like I'm going to lose 132. Okay, that's the worst case scenario, is to lose 132, unless I end up somewhere in the middle where, this is 132, and the likely outcome of the trade is going to be more like $32. Worst case is 132 down here. And again, that is in my case. In your case, you guys have done 2 more tweaks than me, and probably you are in a good position or a better position, and maybe you have a little bit of green that shows up on the top. Okay, so in my case, the management of this trade has been pretty terrible because I missed 2 weeks of live sessions with you guys, but this is basically the risk profile that we have. Okay, so how would you do this? How would you do this trade? Well, I would just go to TOS, and the first thing I would do is go for Nucor NUE, and I will look at the expiration date on the 21st, and we are looking at selling the call, which is the 152.5, which that one's almost impossible for me to be filled. But you know what? Let's have a bid there of 15 cents, as we always do, and we can make this good till cancel. I'm just gonna throw this order out there, even though the probability of being filled on the call is very, very low, because that market is way too low. Okay, so 132.5 call, okay, 15 cents, good till cancel. The order is in. Probably I won't get filled, but if the market rallies in a spectacular manner, that, hey, I've seen that happen, so then you will get it. On the put side, I'm gonna go for the 124. Okay, the 124. So I'm gonna sell a single strategy. The midpoint seems to be 97 based on this. Real time is more than that, but anyway, I'm just gonna go with whatever I see. Okay, and now the moment I get filled on that 97, which I did, Immediately I got filled at 144, which is I thought it was better. Immediately you want to close the stop. Okay, so sell, market, get out. That's it. So I'm out of the stock. Okay, I'm out of the stock. Okay, and I am in the 124 put. Okay, now let's talk about this a bit more now. So I just got rid of the stock. Okay, which price did I get on the way out of this stock trade? I got 125.3, and that stock was assigned to me at 125. So actually I made 30 cents on the stock trade. If I made 30 cents on the stock trade, well, one easy way to simulate that is to pretend I got, like 30 more cents here. So instead of 7.28, it's like I made 7.58. I got 30 more cents because I sold the stock at 125.30, which is 30 cents higher. So what happens now is that if that stock keeps falling, I will end up losing $2, basically breaking even. If it stays here, I am risking $100 in this trade. Okay, so which, if you recall, this trade started with $1,000+ of risk, and let's face it, there was a very disadvantaged moment, very disadvantageous moment for a long time, where multiple tweaks were done for very little premium, and almost every single tweak with a call was missed. If the stock had behaved a little more non-directional, this trade would have ended up with a profit for sure. And also, if I had done a better job at managing it during these weeks, which I missed the live sessions with you, probably the P&L of this trade would be much better too. Okay, so happy to hear from you on the chat box on how did it go for you guys. In any case, this trade now is basically over. I'm just gonna right click and copy this and put it on the positions panel, just because this is what we do. But basically this trade will now expire tomorrow, and this trade will be over. Okay, cool. Time to go and check Amazon. I would certainly like to see your comments there on Nucor. Let me see. Ahmed, how are you, my friend? Good to see you. We have Mark. The Nucor 155 call has not been filled in 3 or 4 weeks. Exactly. You are correct. With fills on the call side, which would have happened if the stock didn't fall that hard, this trade would have looked much better. In any case, it's been okay. Yeah, got you. Perfect. Now Amazon, next one. So Amazon is also a very similar type of trade. Okay, it's also double calendar. Okay, it's also a double calendar. It's also a trade. We started this trade, in here. Notice how I got 1, 2, 3, 4 versions of Amazon here because of the multiple tweaks that we have done. The last one we did, if I graph it, we're gonna have the same issue. Okay, it shows only 2 legs. Is it because there are 2 legs? No, there are more than 2 legs. Okay, there are more than 2 legs. The only problem is that I didn't do the roll last week, and that's why I'm missing 2 legs. So the same thing applies. I'm gonna add 2 legs. Both are gonna be sell. In this case, we're gonna be dealing with October 21st. Okay, the expiration is on the 28th, which is next week. So we are not diagonalizing the double calendar yet. We keep it as calendar. So on the call side, we're gonna make it 139. Oop, I went way too far there. 139. On the put side, we'll make it 121. Okay, so if we do that, it seems that we can get nothing for the call, 1 cent. So similar issue compared to the other trade that we are discussing. And on the put side, it seems that I'm gonna get $300. Okay, so let's take a look at what we already had there. So we had 620 and 69. So let's go ahead and add 69 to the call side. Okay, and let's add 620. okay, 620 to the put side, knowing that we're going to get 372. So if I take 372 and I add 620, that would be a total of premium of 992. Okay, 992. So if I do okay, this is gonna make this trade to look very beautiful, right? It's making this trade look like we are making $472 and this trade cannot lose. It's not exactly like that. Okay, you will see why in a moment. Okay, so I want to go back to Thinkorswim first and do the same thing I did before. I got my 100 shares of stock, so I need to do the same thing. So Amazon, October 21st, we're looking at the 139 strike. So 139 strike for the call. Again, there is no premium at all. We're just gonna place an order just in case there is this beautiful rally. Okay, this beautiful, beautiful rally. Uh, 15 cents. Okay, that's it. The order is in. And we are also going to get the 121 put and sell it at whatever price we get. And the moment I get filled on the put, I will then close the stock. I just got filled at 365, so it's now time to close the stock. Okay, just got filled. So now what do we have? Well, that stock was put to us at 121, and we just exited the stock position at 117. So what does that mean? It means that we lost money on the stock. Okay, how much we lost? Well, the difference between 121 and 117.47, the difference is 3.53. Okay, 3.53. So we didn't get 365. Actually, I added 372 earlier. Okay, so we didn't get 372. We got 372 minus 353. Okay, so in other words, let's do the real math. So 353 minus 365, that means that we got net 12 cents out of what we earlier had. So those 992 are to be diminished. Okay, 992 are to be diminished by the $353 we lost when selling the stock that was put to us at 121 that we just got rid of at 117. So let's see, 992. Okay, 992 minus 353. That was okay. So 639 is the number I should have here, not 992. Okay, that's why I said it's not the same. Okay, in the other case with Nucor, the stock was above the put strike. In this case with Amazon is below. So if we do this, okay, we end up with this position, which is actually pretty cool. Because now the most we can lose in this trade is 162. Okay, we are now up by $136, and we can still have an increase of profitability. Okay, now let's take a look first of all at the earnings date. Has the earning date changed, or is still there in the same place? It seems that it's still there in the same place. And also, I both on Nucor as well as on Amazon, I did the roll using October 21st. With Nucor, for sure, I did the roll on October 21st because the whole trade it's over on October 21st. But with Amazon, to be honest, I should have done October 28th. I did October 21st, so you can see how the roll is. But this is what I should have done last week. Last week, I should have got my October 21st put. So now what I should be doing is I should be looking at, do we have distorted Greeks, yes or no? That's what I should be doing. And then rolling into October 28th and converting the double calendar into a double diagonal. But I wanted to do it first so you understand what is it that we got on our hands. So two things. First of all, since the earning date is still valid, is still right before our expiration date on earnings October 27, expiration October 28. So since that has not changed, if I was to sell options that expire on next week now, I'm still going to get a kick when it comes to implied volatility. Okay, so if we look at the option chain on Amazon, if we look at October 28 and I look at October and November 4, for example, so notice how here I got 75% implied volatility because earnings are priced in, where the next week I got 62% implied volatility because the earnings are gone on November. So if I use this particular expiration date, I'm gonna get a little bit of an extra kick. So let's try to do it with both the call and the put. I'm gonna start with the call because the call is simple. So the call on Amazon, which is here up on the top, I'm gonna edit to replace and make it October 28. And remember, because now I'm taking the double diagonal and making it a double calendar, I'm gonna push this up to the next allowable strike, which in this case is 139.5, not traded. So it's gonna be 140. Here we go. So I'm gonna go with 15 cents. Okay, same thing. I'm just changing the expiration date and pushing one strike beyond for Amazon. I'm gonna click send. Okay, that order is being sent. Again, this is trading at 16 cents. So you know what? I may get lucky and I may get filled on that. That would be great. Okay, how would that look like if I get filled? Well, it would look like instead of October 21st, it's October 28, and it's 140. And I'm not going to change the price because I have not been filled yet, so I'm going to leave it like that. Okay, it will look like this. Okay, so if the stock rallies, on the way up, I profit. Okay, now on the bottom part, I'm going to take the 121 put from October 21st and make it 120. Okay, 120, I'm going to roll it. So if I roll the 121 put to become October 28, it looks like I'm going to collect 3.02. That's going to make my Amazon trade a sure thing profit. Okay, if I'm not mistaken with the math. So let's do it. I could have done it directly, okay, but I wanted to do it in two steps, so you see. Okay, so trying to get filled at 3. Mark is 302. Okay, let's see if I get filled. Just gonna drop it a bit. 295. See if I get filled. I want to get filled quick. Don't do this at home. Take your time at home. Little bit of lack of liquidity on that strike. Take a look at the option chain. 121 strike, October 28. 645, 660. Not too bad. And 345, 360, a little bit wider there on the front wick. So I guess that's the issue. Again, with patience, I believe that it should be doable to get filled on that one. But I don't want to use patience because I want to find other trades for you guys. So allow me to rush it a little bit. Hopefully I get filled now at 290. Not yet. Come on. Okay. I'll do it one more time. 25. Okay, got filled at 290. Thank you very much. So I got filled at 290. Okay, 290 is what I got. And therefore, now I can go back to my trade here, edit the spread, and the put, which is the last one left, is now becoming October 28. And instead of 120, I just did a mistake, my friends. I just made a mistake. Yes, I rolled it. I rolled it to be 121. Yes, I made a mistake. Human error. And this is strange because on the bottom part of TOS, it doesn't show correctly. It shows the 121 put, it shows as 0. Oh, yes, of course, it shows correctly because I just closed it. That was so silly of me. I just sold the same strike and I closed the trade. Amazing. Like I've never done this before. Anyway, please allow me to fix it, at least visually speaking. I mean, if I was to make a mistake like that by myself when I'm trading with real capital, I would just leave it there. That's it, done. Because this trade is profitable, so I would just not, go back in and everything else because it doesn't make sense because the trade is profitable. But I'm gonna do it. Okay, I'm not gonna do it just so you see how it would be like. This would be buy the 121 and sell the 120. This is how it would have looked like. I'm just gonna get it in so you will see it exactly. So now you can see here how I got my 121 put back and a short 120 put. Okay, so this visually speaking is what you would see. Of course, I wasted spread and commissions by doing all of this. So if this ever happens to you that you make a human error, it happens to all of us, then you just leave it like that and that's it. But I just wanted to bring in, and I just got filled on the 140 call. This is great. Just got filled on the 140 call, so now I got my whole thing. Okay, great. Thank you very much, market. So I got my 120 put, which is below 121, 140 call, which is above 139. Okay, I got the whole set of legs, which I needed. So thank you very much. Now, the one thing I need to calculate really is my P&L properly and my risk. So let me go ahead and do something very quick here. So if I get a chain and I edit the spread and I do rolling the 121 in the 121 in October 21 and selling the 120. That was my mistake. I did 121, selling the 120, and this is put. I just want to see how much I would have collected by doing that, and it's 235. Okay, so 235, it's the improvement in the price of what I have already got. Okay, 235. So what I had was 669 on the put side. I just added 235, making it 904. Okay, and this is probably very complicated to watch, especially after my mistake. But if you go back to watch the recording, I believe this is quite useful as a demonstration of things to do and things that happen both. So I'm actually in a way glad that this happened, even though I'm probably confusing some of you because it was a lot of back and forth, and if you are on top of that my mistake, it doesn't help. So the recording will be there to support. But anyway, good news, this is the trade we have now, and if I click OK, notice now that worst case, we're going to make $73. Okay? Worst case, we make $73. And if this market continues falling or rallies, depending on where it goes, we're going to make 173. Okay? That's it. No matter the earnings, no matter what, this trade has a locked-in profit of 73, and best case will make 173. So this trade worked according to plan. It could have been better. Okay, it could have been better. And I'm going to go back to the chart and explain what I mean by it could have been better. What it could have been better is that just like Nucor, this very intense movement to the downside made it problematic. Okay, so if Amazon had been a bit more behaved, we would have got so much more premium, and this would have been much better. But still, we benefited very much from the increase of volatility going into earnings, and this together with the time decay, we were able to manage this type of outcome, which is great. Sorry, guys, I just made something fall. Good. Jeff, Jose, do you exit the put leg since it's in the money by 28? Let it expire. Yeah, the idea here is to let the whole thing expire. Of course, if you end up between strikes, okay, if you end up between 121 and 120 or 139 and 140, let's say you end up at 139.5, then you're going to get assigned shares. And we talked about how to deal with that in the past, isn't it? You may go, using the post-market trading, and you go over short shares. So when you get assigned, it neutralizes it, etc. Right? So we talked about all of those things. But normally, odds are, especially after an earnings report, the stock is going to move fast in a specific direction, and you will likely end up either above or below, 121 or 140. Okay, so then you just let the whole thing expire. Cool. And the last trade, it's PayPal. Okay, and PayPal is a trade that also needed some management actions here. So notice that so far PayPal is within the purple line. PayPal will expire also on October 28. Earnings is happening after, so it's great. This is an iron condor. This trade is working according to plan, but while it's working according to plan, during the life of this trade, okay, notice on that particular day, we had a cross of the volatility projection line, the cone, on what the purple line was. So at this moment in time, okay, the right action to be done would have been to roll down the calls, which I didn't do because we didn't meet, okay? Roll down the calls, okay? And there have been multiple other cases of needs to do that. Right now, given where the price is, we're fine because we are crossing this after the expiration date, so it's fine. But some rolls should have happened. Okay, so because I didn't do the rolls, okay, and it's been a long time I didn't show how to roll an iron condor, I'm just gonna do a quick roll now, even though it's not really the ideal day to do it. But basically, the way you would do it is that you would use the probability cone on the upside, which is the opposite of where the challenge is. Okay, not today. The challenge was a few days ago here. So you would use the upper side, okay, and then you would just go down to lower time frames to find UFOs beyond that. Okay, so let me see. So the UFO beyond that is going to be this one here. Okay, and therefore we will now present a purple line located right here, which is the next UFO above this red line. So if I go back to my daily time frame, basically what we're being told is that, look, the call side, which is located at 110, 115, should be rolled down to, let's say, 100, 105. Okay, we need to push the calls down to this location and collect an extra credit doing so. So let's take a look at the risk graph. Okay, let's take a look at the risk graph. This is the risk graph. Okay, we're gonna compare spreads, copy the primary, and what I'm gonna do now is first simulate with two more legs that I am going to close the call side. The call side is 110, so buy back the 110 and sell the 115. Okay, if I do that and I click OK, this is simulating closing the call side, and then I'm left with a diagram, which is the diagram of a put spread, bull put spread. Okay, you can see here with the orange line. So now that I close the call side, I want to add two more calls. Okay, one is buy, one is sell. And the ones that we're going to use now are, as we said, 100 and 105 to keep the distance equal to be $5. Okay, and by doing that, we are now bringing additional credit in, which, to be honest, it's very, very, very little. It's 11 and 4. It's basically 15 cents, and I need to pay 3, so I'm gonna bring in 12 cents maximum. It's not amazing. Okay, it's actually quite disappointing. But yeah, again, it's also happening because of the fact that I didn't do it at the right time. So in any case, I'm just gonna do the roll, so we have it. So PayPal, again, this is an iron condor. Notice everything is October 28th. I'm going to take both calls, okay, those two calls, and then I'm going to create a closing order. Okay, I'm going to create a rolling order. Okay, and when I create the rolling order, I end up with 4 legs. Now, the system by default would assume that you want to change dates, and the fact is that I don't want to change dates. I want to stay on October 28th. I want to change strikes. Okay, so we are buying the 110, selling the 115, and we are selling the 100 and buying the 105. So if I do that, I get 7 cents of credit. That's the midpoint. And it was 15 minus something. I said 12, but I guess that the bid and the ask spreads have been moving and may not be too good. I mean, to be honest, I will not bother to do it for this amount, but I'm just going to do it since I missed so many trades in these couple of weeks where I was not able to join you live. I'm just going to put it out there. So, hopefully we get filled. Let me try. This is painful for me to see, to do a trade like this for such little amount of premium. Again, I would never do it. We talked about this in prior sessions. I'm just doing it so just I have the trades in the system. Okay, so I'm gonna leave it there and see what happens. Hopefully, I'll get filled before the end of the session. Cool. Yeah. So I'll just float my risk graph, leave it alone, and we'll come back to this later with PayPal. 15 minutes to go, my friends. Okay, we need to find a trade. So again, let's go back to the S&P and see what's happening. So the S&P is basically doing the same thing. So with that, I would expect the implied volatility to have not done anything really, and therefore I would kind of feel like finding opportunities which are double calendars may be a better choice, since the volatility is probably dropping during the intraday session. So what I'm going to do is look for cheap options. I'm going to start with my demanding mean less than 20. And I am going to be looking at my scan list, any increment options, and I'm going to be looking at neutrality in a daily and neutrality in the weekly time frame, and I want earnings to be at least 30 days from now, and that is it. Perfect. Okay, so scan. Let's see if we got something. No. What if we do, instead of so demanding with volatility, we do CAV mean below 2 standard deviation of the historic, and now we got UNH and Goldman Sachs. Okay, so let's take a look at those two. This is January. It's very, very far in time. Very, very far. We could, but it's really, really far. What about Goldman Sachs? Goldman Sachs has earnings also, just as far. So, not delighted. Let me see if I can find opportunities with implied with earnings a bit closer. So we are going to do greatest decrease on the mean in the last 5 days. And this is also giving me Agilent, Autodesk, and Deere. Okay, so this one I'm going to pass. Only monthly expiration dates. And then we got Autodesk. That one sounds interesting. Okay, so we have earnings right here, and then the next expiration date is 11/25. Okay, so let's take a look at this. Okay, we're going to be looking at this particular stock, Autodesk. We're going to be looking at this. Okay, let me look at the monthly time frame for Autodesk. Okay, we don't have data to go that far. Okay, yeah. we got price above. That's what I wanted to see. Okay, great. So, and then looking at this particular expiration date, we're gonna come here. Perfect. Okay. So now, with this in mind, let's look for UFOs above and below. So above, I got this guy. I could come here. I could also come here, to be honest. And below, oh, wait a moment. These UFOs are 46%. That will not be acceptable. Okay, so I'm gonna check 34. 34 is 51%. That's good. Yeah, great. And I have a UFO there. So this is fantastic. Okay, and like this. And if I look above, here we go. This is where I'm going to go. Good. So this seemed to me pretty fair. So yes. So we are talking about a top of 241.5. So 241.5 is the top. The bottom part is 167.23. So we're talking about a range which is 74. If we divide this by 3, we are talking about 24. And if I add this to the bottom part, 167.2, that is 190. So we're going to be targeting the 190. Okay, 190. And we're going to be targeting as well 241. 4 minus a third is 216, so 215. And we should have those strikes available, 215 and 190. So let's take a look at the option chain. We are looking at expiration date being November 25. And October 28. And we are looking at strikes 190 and 215. Yes, they're available in both. We got 727.90. We got 7661. Yes, this sounds great. Okay, so let's do it. We're going to be buying this guy and selling this guy. And we're going to be buying this guy and selling this guy. So by sell, this is correct. Here we go. So let's graph it. So our double calendar, did I do something wrong here? I think so. The risk profile. Oh, yes. The strikes are not correct. On the call is 215. On the put is 190. I'm not sure how I did that. November, October, November, October. Yeah, this is great. Cool. Yes. So we recognize this, isn't it? So this is our classical graph for our calendar. The initial risk of the trade is $1,160. Of course, we're going to massage that throughout the week as we are approaching November 25. So this will diminish by a lot. Of course, depending on account sizes and risk management rules and everything else, this may be a large trade for you. This may be a small trade for you. If it's too large, I would say practice it in a demo account. That may be a good idea, unless you have other things in your hands. But if not, that would seem a good plan to me. So I'm just gonna get Autodesk on the screen. We are looking at, is it November 25? Wait a moment. Yes, November 25. Correct. November 25. So we're going to be looking at November 25, and I am buying the 190 put and buying the 115, and then using October 28, we are selling the 190 put and we are selling the 115 call. Okay, so this is the trade, 1165, 1160. Okay, so yeah, that's the trade. I'm just gonna place the order in and see if we get filled quickly. Seems that the mark is 165, so let me try to pay a bit more for that. Let's see if I get filled like this. And in the meantime, I got filled. Yes, I got filled. So how much I got? I got filled at 178, which is 755 and 695. $695, $755, and then on the shorter expiration date we got 127, 145. Okay, and that is 1178. Perfect. I did it right. So I'm gonna copy this to the clipboard, bring the positions panel, and I'm gonna put this at the bottom part under PayPal. Here's our Autodesk trade. We got it. We're about to reach the top of the hour. Believe it or not, we did get a trade in place, so we can work on this trade in the following days. Again, another non-directional trade. My friends, this is what the market has to offer. So that's what we do. Adjust these lines to be 215 and 190. Now I keep my drawing consistent with other trade, and I do not drive you crazy. Here we go. That's how we did it. Okay, cool. So questions, everyone, how is it going? I did not get filled on the PayPal thing, by the way. Just gonna go crazy with it. I'm gonna make it market. Please never do that ever. Okay, I just wanna get filled so I have it, documented, so we can work on it on future sessions. Because of the lack of liquidity of these strikes and how close the expiration date is, I may not get filled. And if that's the case, sorry, not because of the expiration date, because of the strike is quite far, I meant to say. I may not get filled, and if that's the case, then that's the case. But I would really like to get filled, so I have something more similar to what you have for the future sessions. So we are going to call it the day. We are going to call it a day. Everything has been done. The only thing that has not been done is obtaining the orange risk graph, which again, there's no point of doing it. If you haven't done it on time, there's no point of doing it. If you had done it in the past few days, you would have got much more premium, and this tweak would help the trader. If you have not done it, doing it today, it's going to add 5 cents. So it's really a waste of time. Okay, so don't do it. I'm just trying to do it so I can, work on it on the future sessions. Cool. So anyway, I guess we're gonna call it a day. My friends, thank you so much for joining me today. As always, it's always lots of fun. I missed you last week. Yeah, it's always a special time for me when we get together to trade. And I see today much less questions compared to other sessions. And I believe, I have a feel, please let me know if that's the case or not, but I have a feel is because, the set of rules for non-directional trades, both for positive vega, such as double calendars, or negative vega, such as iron condors, the set of rules are quite clear. I believe that many of you have been practicing this for a while now, and certainly since the market conditions in the recent times have been all about non-directional trading, because directionally speaking, the market is not defined enough. So I guess that the reason why there are a few questions is because the rules are clear, which is good. But just remember that anything that you may need, I'm certainly happy to take a look. By the way, before we say bye, Joe, oh, look at that. I think I just got filled on the PayPal thing. Did I? Yes, I just got filled. I got a credit of 4 cents. Wonderful. So let me update it. So we have it updated. And also, Joe, if you want to phrase your question, if not, if you give me a moment and you're still here, I'm going to read your email. And then I can respond to you in the session live. So please confirm to me that you're still with us, Joe, so I know that this would make sense for me to do. So positions, PayPal. Here we go. Raise graph. Edit. So we converted these to be 100, 105, and by doing that we got 4 cents. So that is equivalent to making these 77. Okay, so basically it's the same thing. It's again, it's kind of like a waste of time of tweak, but I had to do it. So I have it the way it needs to be for future sessions. Okay, so I believe that Joe may not be with us anymore. So then what I will do then is I will basically just close down the room and say bye to everyone, and I will respond to Joe in an email form. Everyone, keep up the good work. It's been great to spend an hour with you guys as always. See you soon. Take care. Bye-bye.